All right, we're jumping right in and we are talking about Trump's OBBB, the one big beautiful bill. It's a beautiful bill. It's such a beautiful bill for the beautiful people. All right, let's break this down. Sorry for the impersonation. All right, the OBBB, I mean, this is big. This is as big as what I'm saying, the New Deal, which was, of course, what FDR put in place decades and decades ago. Now, maybe not as big. I mean, that was really a fundamental shift of the entire government, really moving America into more of a socialist type system. But it's a big deal. And really why this is such a big deal is it's changing what I'm calling the polarity of the entire country, of the economy, of the difference of the rich and the poor. It's changing the polarity of how wealth is made. It's moving from a tax and spend type of a program to a build and grow type of a program. And so what this is really doing is going to be igniting or attempting to ignite growth so fast that maybe we can grow our way out of this debt. All right, we'll talk more about that. But this is really switching things around. And the key thing is, regardless of what the mainstream media is trying to tell you, it's not just for the rich, okay? This is for every American. This is benefiting blue-collar Americans. This is benefiting people working minimum wage. This is benefiting seniors on Social Security. This is benefiting all Americans in this. And the thing that I really want you to grasp is to approach this with an open mind, because there is real stakes at play right here. I'm going to break down this entire blueprint for you. I'm going to give you the totals. I'm going to give you the amounts. I'm going to give you the action plan. I'm going to show you at the end how this all stacks up. There's real stakes. Unfortunately, most are going to sleep on this, but I'm going to break it all down for you in the most concise way I possibly can. There's a 7-step strategy that I'm going to give you right now. Of course, now, look, the bill is way bigger than 7 pieces. It's a massive bill. What I've done is I've pulled out 7 pieces for this video that I think are relevant. All right, so the first one is my favorite. We're going to jump right into my favorite, and this is bonus depreciation, accelerated depreciation. All right, this was given to us in the first set of Trump tax cuts in 2017, but it was 100%, 80%, 60% dwindling down. Now we've gotten 100% for the next several years. So what is this? Well, the what is you can now deduct 100% of depreciation in year 1. So if I want to invest into equipment for my business, if I want to invest into a new rental property, if I want to invest into a new vehicle, things like that, normally those would depreciate over a long period of time. 5 years, 10 years, 27 years. But under this, I can take 100% of that in year 1. Now why? Why would I want to do that? Well, the reason why we want to do that is because we have income, we made money, we have to pay tax on that. That's taxable income. If you don't want to pay more than you should, what you can do is you can take depreciation from somewhere else and write off the depreciation against the income, so you don't have to pay as much. So easy numbers. I made $100,000. I have to pay tax on the $100,000. But if I get $100,000 of depreciation, those cancel each other out. You follow along? Okay, how can we do this? Now there's endless amounts of ways that we can do this, but let's talk about one. I could buy an investment property. I could buy a rental property in San Antonio, Texas. I could invest into that. And what I could do is I could deduct the depreciation against my earned income. So for example, if I calculate this out, let's say that I buy a $500,000 property in San Antonio, Texas. I'm going to put $100,000 down on that property. Now, what I'm going to be able to do though is I can take potentially maybe not the whole 500, maybe 450,000 as a deduction against my income. Now, if I'm in a, say, 37% tax bracket, that is $185,000 that I would have normally had to give to the government that I can now keep for myself, and I can invest any way I want, and I have the investment property earning an income at the same time. All right, the second one is interest expense. Okay, so what is this? Well, we can fully deduct interest expenses on business loans. So if I have a business, anyone can have a business. You can set up an LLC, you can set up a corporation, you can start a side hustle. But if I have a business and I take a loan through that business, I can deduct the interest expenses for that. How do we do that? Well, what we want to do is we want to take loans to grow our business. So for example, I want to take a loan to grow my business. Maybe I want to take a business line of credit so I can expand, so I can hire new people, something like that. And what I can do then is I'm using the loan to grow the business, but the interest expense that I'm paying the loan now comes off against the earned income that I have. Why would I want to do that? Well, because if you have a business, you should be investing into it. Again, if I'm adding equipment, if I'm adding employees, if I'm investing into new business lines, then I should be able to grow my business. It's usually the best place that you can invest. But when I'm doing that, growing my business to grow my wealth, I can again write off that interest expense. So let's calculate how this might actually equate to dollars in your pocket. So if I have about $500,000, I borrowed $500,000 to buy that new investment property. Let's use that again. Let's say I'm paying 7% interest on that debt. All right, that's going to be $35,000 of interest that I'd pay. Now, if I'm at, again, 37% tax rate, that's giving me about $13,000 in savings. Again, $13,000 that would have gone to the government, but now I get to keep on my own. Now, let's just say that I have this extra $13,000. I didn't give it to the government. I can now invest that money into something else, like a new side hustle, a new business, a new line for my own business. Maybe I want to buy Bitcoin with that. But that's $13,000 that I wouldn't have had normally, the government would have. Now I get to keep it, and I get to buy Bitcoin or something else with that. All right, and number 3 is R&D expenses, research and development. So the what? What is this? Well, what we can do is now we can immediately deduct any research and development costs or expenses that we incur in our business. So you have a business, side hustle business, LLC, a real business, whatever it is, you should be always research and developing. You should always be looking into new products that you could develop or new lines that you could introduce or things like that. And so now you can immediately deduct those expenses. How do you do that? Well, basically you're going to invest into these new products. Like I said, you're going to invest some time hiring someone to go look at it. You're going to invest some resources, time to think about that. And now what you can do is, as you're invested into those new products, you can expense all of that this year. So let's calculate this out. If we calculate it, let's say that you spent $100,000 in hiring someone to go research this out or in testing products or whatever that is. So you spent $100,000 and your corporate tax rate is say 21%. Well, now you've saved $21,000. Again, $21,000 that you would have given to the government, you didn't have, but now you get to keep that on your own. What do you do with it? Well, we can use that by, again, hopefully we created that new product. And that new product should be growing our business. So now our business is scaling faster. We're making more money than ever before. But also, we have the savings, the $21,000 that we were able to keep, that we can now do whatever we want. Now, I advise we invest that money. We can invest that money into the S&P 500, into more rental real estate to get more tax depreciation. We can buy Bitcoin, which is the best performing asset, or whatever you want to do with that $21,000. Now, we have number 4, which is QBI rules, and they were temporary and now they're permanent. Okay, so what is this? The what is that we can now take 20% of net business income and we can pass that through from the corporation to us directly. All right, how do we do that? Well, let's just say, for example, your business did about $300,000 of revenue. Now you can take about 20% of that, the QBI, which is about $60,000. We can pass that through for ourselves, which now we can take on our personal returns. We can write that off. All right, now let's calculate this out. So let's say we took that $60,000 in savings that would have normally gone to taxes, we get to keep it, and we invest it in just like an S&P index fund, making 7%, and it compounds there for a couple years. That could be up to $22,000 we get to keep for ourselves. We could also use it even more. Let's compound this out over 10 years, just so you can see the impact of this. I know a lot of these numbers look kind of small. You're kind of like, why bother? But let's say that we take this out 10 years. So now we're compounding 7% in an S&P index over 10 years. That's $43,000 more that you wouldn't have had. Or if we put it into, say, Bitcoin, for example, which is going about 60% a year, let's call it 35% a year compounding, that's almost $500,000 that you would get in your pocket from just this one new permanent rule. Okay, let's go to number 5. Number 5 is a SALT cap. Now, what is this? Basically, what we have is we have now state and local tax deductions, and it increases to $40,000, previously only $10,000. So, for example, if you live in a high tax state, like California or New York, you have very high taxes that you pay in that state, and now you're able to deduct those taxes against your federal income tax. And like I said, they increase that. all the way up to $40,000. So how do we do that? So again, in the state that I have, I calculate the income tax I paid in the state, I calculate the property tax I have, and we can take it up to $40,000. So let's use $40,000 as the example. I take the $40,000, I deduct all of it. All right, again, previously it was $10,000. Deduct that. Let's do the math. So I take the $40,000 that I paid to the state, and I deduct it from my federal, so I don't have to pay tax on that. Again, using a 37% tax rate, that's $11,100 that goes back into my pocket. And it would have gone to the government in the past. Now I get to keep that. What do I do with it? Well, I put it into other investments, of course. How do we do that? How do we use it? So let's say that we take that $111,000 and I use it as a down payment on a $200,000 rental property, for example. Then what I can do is I can take that $200,000 rental property and I can take the bonus depreciation on that, on the building, and I can write off, let's say, another $150,000 against my earned income. So now I saved the $111,000, I parlayed that into a $200,000 rental property, of which gave me another $150,000 of tax write-off, plus the property's earning about $15,000 per year, plus the property's appreciating. We can continue to add that up, but you get the point. This is a really big deal. Okay, that takes us to number 6, which is excess biz losses. All right, so what does this mean? The what is that we can now fully deduct business losses against our income. This is a really big deal. Again, if you own a business, you should. The reason why you should own a business is because the tax code, if you can tell, the tax code was written for producers, for business owners and investors. The tax code penalizes consumers. If all you do is consume and work a W-2 job, the tax code sort of penalizes you for it. But if you start a business, could be a side hustle, could be a hobby business, but if you start a business, then you can start to take advantage. If you're an investor, you can start to take advantage of some of these. Okay, how do we do it? Well, let's say that for my business, we launch a new product. We've talked a lot about researching, developing new products, launching new products. So let's say that I did that. I launched a product, I built this whole thing out, we launched to sell, and it didn't go so well. I've had product launches that didn't go so well. So let's say, for example, I lost $150,000 in that product launch. Okay, that's too bad. But what I can do is I can offset that loss against my salary of, say, $200,000. So now let's calculate that out. So I get the $150,000, again, at a 37% tax break, or tax rate. That'd be $55,500 that I would have normally had to give to the government that I get to keep. Now what I do, hopefully, is I take that and I put it into investments. How do we do that? Well, let's say that I want to invest the $55,000 into Bitcoin. I'm going to put it into a Bitcoin fund. And the Bitcoin fund is able to outpace Bitcoin, so let's call that 60%. That could potentially yield $33,000.3 in year 1 alone, and then it continues compounding from there. So again, this is $55,000 that would have normally gone to the government, but now I get to keep it. I can invest into a high value fund like this and potentially make up to $33,000 back. So I got the 55 plus the 33 back in year 1 that I normally would have had 0. Are you starting to see how these start to add up? Okay, let's go to the last one, number 7, that I'm going to use in this example for this video. So number 7 is a QOZ, and it went from temporary to permanent. This is for an opportunity zone investment. So what is it? Basically, what this opportunity zone allows us to do is to defer our cap gains, and then after 10 years, we get it completely tax-free. So what are we talking about? So if you have cap gains, so you bought a piece of real estate, you sold it later, you made money. You bought Bitcoin, you sold it later, gold, whatever asset you bought, and then you sold it later, you had cap gains. What you could do is defer that cap gains, meaning don't pay the tax now, by investing that money into the opportunity zone. So for example, I've sold the asset, a piece of real estate, the gold, the Bitcoin, and let's say that I had $100,000 of capital gains that I made from that. Okay, well typically again I would pay tax on that, but instead I'm going to roll that into an opportunity zone fund. If we calculate this out, so I have this $100,000, now long-term capital gains, meaning that I've held it for more than a year, is taxed at 20%. So that means on this $100,000 I would normally owe the government $20,000 that I have to send to them this year. But by putting the $100,000 into the opportunity zone, I get to keep that $20,000 for myself. Meaning, well, the tax is deferred, but I have the money now. It's liquid for me right now. Okay, but I invested that money again into this opportunity zone, and let's say that the investment's doing 10% a year. Okay, so if I put that in there for 10% a year and I hold it for 10 years, because at the end of 10 years I get it tax-free, that would be $259,000 that I've made, and I get the $20,000 that was deferred that I've got to keep that whole time. All right, so let's say that the $100,000 went into the opportunity zone, but I kept the $20,000, and let's say I put that into Bitcoin. And again, it's going about 60% a year, but let's call it 35, half of that. That Bitcoin then turns into $411,000. So if you're starting to follow along here, we're making exponentially more money without making any more. This is all money the government is allowing us to keep, our own money. Thank you for that. Thank you for allowing us to keep our own money. But by keeping more of this money and just investing it, you can see we're exponentially scaling it. Now, if we total all this up, that's over $327,000 back in your pocket with a little bit of strategic levering. But let's show this total here so you can start to understand how powerful this really is. So first, let's look at the tax savings. Again, this is the government allowing you to keep more of your own money. So from the bonus depreciation, we would have got back $185,000. The interest expense, $12,950. From R&D, $21,000. QBI, $22,000. The SALT, $11,100. Excess losses, $55,500, and the opportunity zone deferred taxes of $20,000. So again, totaling all that up, that's $327,750 of our own money that normally would have gone to the government to do who knows what they're doing with it, but now we get to keep it and we get to grow our own wealth with that. Okay, this is immediate liquidity that you can reinvest your capital. So now what do? Well, of course, we want to reinvest that. Now, using the examples that I've already given you, we can now multiply that, all right? Let's look at it from a conservative scenario, and then I'm gonna show you an aggressive scenario. A conservative scenario, let's say that all that money, the $327,000, I'm making, let's say, 7 to 10% a year. I mean, this is like the most conservative case. This is like stick it in the S&P 500 index and just kind of forget about it. And that's 10 years, all right? It's over 10 years. So 327,000, 10%, 10 years is $851,000. So by taking advantage of these, keeping more of your own money and putting it super conservatively into the S&P 500 is almost $1 million. Plus, we have the rental property that we bought, right? We bought that as well. So we have equity in that, $100,000, plus we invested into our business. So let's say it's growing at $200,000. So from a conservative basis, that would increase our worth in just 10 years to $1.15 million. And that's without making any more money. That's without making any more. That's just keeping more of what you have and investing it very, very conservatively. Now let's say that we want to invest it a little bit more strategically, maybe more aggressively. So now we have wealth multiplication, aggressive. So now we take the QBI reinvestment, let's say $457,000. We have those excess losses. We said we put that into Bitcoin. So that's now about 3.5 million. We did the opportunity zone Bitcoin combination. So that's 671,000. Again, go back and watch those slides if you want to get caught back up on this. Rental property, right? We've got the rental property. It's $100,000 equity plus about $80,000 of net income during that same time, 10-year time period. The business growth, $200,000 of added value. So now, again, without making any more money, just keeping more of what we had and stacking it, or I should say investing it through a strategic layered sequence, is over $5 million. All right, this is the power of understanding what Trump has just done with the OBBB, and more importantly, learning how to actually use it. It's one thing to hear about it. It's one thing to watch me break it down, but it's a whole nother thing to actually implement it. Now, this is Trump's endgame. As I told you from the opening of the video, there is something much bigger here. What we're witnessing is a massive wealth transfer from the government dependence to private wealth creation. From government dependence to private wealth creation. Instead of the government taking all of your money, they want to allow you to keep some of it back. So you can build your own wealth and become independent from the government on your own.